Welcome back to this explainer on the master calendar. Look, if you've ever found yourself just reacting to seemingly random market drops, it's absolutely time to shift your strategy. Today, we're going to stop reacting and start anticipating. We're doing this by tracking the exact dates when critical economic data drops. So if you want to understand how the pros position themselves days before the news even hits the headlines, you are exactly in the right place. Let's dive in. To hook right into the framework we built in part one, you'll remember that all economic data falls into three critical buckets, right? We've got leading, coincident, and lagging indicators. Just as a quick refresher, leading indicators, like housing starts, signal what's coming down the pike. Coincident indicators, like personal income, reflect what's happening right this second. And lagging indicators, like the unemployment rate, well, they only change after the trend has already shifted. So keep that three-lane framework in your head as we start mapping out our timeline. Now, the crucial question for any prepared investor is exactly when these market-moving reports actually land on your calendar every single month. Because honestly, missing these dates, that means you're flying blind on some of the most volatile trading days of the month. But knowing them and tracking them, that gives you an incredible edge. So let's get into exactly which days you need to be circling. Let's map out the terrain here with what we call the Big Six reports. These make up your master calendar. Going chronologically, we always start with the ISM index on the very first business day of the month. This is a leading indicator, and it gives us an immediate pulse on manufacturing health. Then, right after that, the jobs report hits on the first Friday, showing us exactly where the coincident labor market stands. Moving into the middle of the month, around the 11th, we get the Producer Price Index, or PPI, which measures wholesale inflation. A few days later, somewhere between the 15th and the 21st, the Consumer Price Index, the CPI, drops. That's your headline inflation. Right in that exact same window, usually the 16th to the 20th, we see housing starts. This one is a completely crucial leading indicator because home construction ripples out through materials, appliances, and labor. And finally, to wrap up the macro picture, the quarterly GDP report lands in the third or fourth week, measuring overall lagging growth. Okay, so here is where it gets really interesting. There is a hidden, highly actionable relationship between two of those mid-month dates. Let's zoom in on the PPI first, which drops around the 11th. This index measures inflation at the wholesale level. Basically, it's tracking the raw material and transportation costs that producers have to pay way before the final product ever reaches the consumer. Then, just a few days later, between the 15th and 21st, the CPI drops. This one reveals the retail inflation. It's the actual final price that consumers are paying right there at the register. And more importantly, this is the massive headline number that the Federal Reserve watches most closely to dictate their monetary policy. So the big insight here is the connection between the two. You can actually think of the PPI as an early warning offshore weather radar, and the CPI is the actual storm hitting the coast. Why? Because higher wholesale costs measured by the PPI are eventually passed right through to the consumer register, which is measured by the CPI. Producers are paying those header costs days or even weeks in advance, which means a surprisingly hot PPI print is literally your early warning radar that the CPI could surprise to the upside too. Let's look at a real-world scenario from 2021 to see how this builds a massive advantage. Alert traders saw the PPI begin accelerating noticeably ahead of consumer costs. Because they knew how this worked, it gave them weeks of lead time before the CPI prints later that year confirmed that inflation wasn't just transitory, like the mainstream assumed. By reading that PPI radar, they perfectly anticipated the Federal Reserve's aggressive 2022 rate hike cycle. They saw the storm offshore long before it ever hit the beach.
So let's apply this logic with a really quick check. Imagine you're watching your calendar, and wholesale inflation, the PPI, just printed unexpectedly hot. Based on what we now know about this pipeline, how should you anticipate the consumer data, the CPI, is going to look next week? And consequently, how do you think the Federal Reserve is going to react?
The professional chess move here is a straightforward three-step sequence. First, you expect the CPI to run hot as well, all thanks to that lagging cost pass-through we just talked about. Second, because inflation is hitting the consumer, you expect the Fed to stay hawkish. They're going to hold rates higher for longer, or they might even hike them again. And third, which you'll know from our previous analysis, this is an immediately bearish signal for rate-sensitive sectors. We're talking about things like autos, financials, and home builders.
So armed with the big six dates and this powerful PPI to CPI pipeline, your monthly action plan is pretty simple, but it is absolutely vital. You need to build your own personal trading calendar. You want to flag exactly when your portfolio might face a macroeconomic shock. For instance, if you hold manufacturing stocks, you better circle the ISM index on the 1st. If you're heavily into home builders, circle the 16th to the 20th for housing starts. Do not let these dates surprise you.
And as you're continuously tracking all these interconnected data points, never, ever forget the golden rule of macroeconomic investing. Don't fight the Fed. All these dates, the jobs, the inflation, the GDP growth, they ultimately matter for one reason. They inform the Federal Reserve's next move. If the Fed is using this data to hike rates, you definitely do not want to be standing in their way. All right, so we have officially mastered the calendar. We know exactly when the data drops. But that leaves us with one final, kind of provocative question to ponder before our next explainer. You know the timeline, but do you know exactly where to put your money when that data actually hits? Do you know which specific sectors to rotate your capital into as the economic cycle shifts beneath your feet? Keep that in mind because we are going to decode the rotation engine next time.